Welcome to Iron Financial, the forge where we build stronger portfolios by stress testing market narratives. I'm your lead analyst. Today, we're putting Custom Truck One Source, ticker CTOS, on the anvil. They just dropped their Q4 and full year 2025 earnings report, and to be blunt, it's a complete paradox. You've got a company posting what they are calling record numbers across the board, yet the market reacted like it saw catastrophic structural failure, sending the stock into a double-digit freefall. Our job today is to deconstruct this report, to examine the steel, the welds, and the concrete of their financials. We're going to determine if this brutal sell-off represents a solid foundation to build on, or if it's a trapdoor just waiting to spring on unsuspecting capital.
Right, that is the billion-dollar question, isn't it? As the market skeptic, my job is to be the inspector on this site. I see the headlines screaming record performance, but my trading screen is bleeding red. Management is pointing up to the penthouse suite of the skyscraper they've just built, but the market, it seems to be completely fixated on a crack that's spidering its way across the foundation. So let me get this straight. Management is popping the champagne, but portfolios are bleeding. Make it make sense. Our job is to figure out if that's just a superficial paint crack, something easily patched over, or if it's a sign of deep structural rot. Because let's be real, when a company boasts about its best year ever and the market's instant reaction is to dump the stock by over 10%, there is a severe, and I mean severe, disconnect between the story being told and the numbers being believed. Let's get to the bottom of it.
Okay, let's dive right into this disconnect, because it's stark. On the left, you see the undeniable physical reality of what CTOS does. Heavy iron, massive machinery, the absolutely essential tools that are rebuilding and maintaining America's critical infrastructure. This is a tangible, powerful operation that you can see and touch. Now, on the right, you see the market's cold digital verdict, a brutal 10.66% haircut in a single trading session. This isn't just a minor wobble. This is an institutional vote of no confidence. So what we have are two completely competing narratives: the company's story of operational strength, grounded in steel and hydraulics, and the market's story of deep-seated financial fear. We're going to examine the evidence for both, starting with the bull case. Let's see just how strong this foundation really is.
Precisely. Let's lay the groundwork for the bull argument. If you're building a long-term position in a name like this, you're not looking for hype. You are looking for strength, durability, and raw power. You need to focus on the core numbers that can withstand the turbulence of market sentiment. And the case that CTOS management presented is built on what they see as solid rock, record-breaking performance metrics across the board. So we're going to walk through their strongest points pillar by pillar and see what kind of weight they can actually bear. This is the heavy lifting of analysis, so let's get right into the numbers. The first pillar of the bull case is this number right here, $1.94 billion. That's the full year revenue for 2025. Now, this isn't just a big number, it is a company record. And critically, it represents a nearly 8% increase over the previous year. You have to think about the environment we're in. In an economy grappling with higher interest rates and all sorts of uncertainty, posting solid, high single-digit growth on your top line is a very clear sign of resilience. It tells you that the demand for their specialized equipment, for the trucks that keep the lights on and the data flowing, is not just holding steady, it's actively expanding. This is the raw material of any compelling growth story.
Now, what's really interesting here is that this takes us beyond simple sales and deep into the actual mechanics of profitability. 18.4%. That's the year-over-year growth in Q4 adjusted EBITDA. Now, for those of us who track the true operational strength of a company, you know that adjusted EBITDA is a critical proxy for cash flow from the core business. It strips out some of the accounting noise to give you a clearer picture. An 18.4% jump to over $120 million in a single quarter tells you the company isn't just selling more trucks, it's becoming fundamentally more efficient and more profitable at its core. This isn't just empty calorie growth. This is high-quality, margin-accretive growth, and that's what seasoned investors are always looking for.
And this brilliantly illustrates the engine room of the company. 83.6% fleet utilization. Let me be very clear about what this means. This is the highest level they've achieved in nearly 3 years. A company like CTOS has billions of dollars invested in heavy equipment. They make money when that equipment is out in the field, working and generating rent, not when it's sitting idle on a yard just appreciating. Hitting almost 84% utilization means their core rental business is absolutely firing on all cylinders. It signals intense, non-negotiable demand from their customers in key sectors like telecom, rail, and energy transmission. You simply cannot fake this number. It is a hard, cold metric of operational excellence and market dominance.
And here you have it, directly from the command deck. CEO Fred Ross is framing these results not just as a good quarter, but as a proof of concept for their entire business model. When he says navigating challenging market conditions, he's talking about inflation, supply chain snarls, and a tough credit environment. He's essentially telling the market, look, we know it's choppy out there, but our ship is built to withstand the storm. This is a statement of confidence and execution. For the bulls, this is exactly the kind of leadership you want to see, acknowledging the headwinds, but pointing to the scoreboard as hard evidence of their strength and their strategy.
So to wrap up the bull case, the crucial point is this. CTOS isn't just a company having a good year. It's a structurally sound enterprise that is bolted directly onto the biggest multi-decade growth trends in the American economy. We're talking about upgrading the nation's fragile electrical grid, building out the backbone of 5G and rural broadband, and modernizing our core infrastructure. These are projects backed by trillions of dollars in both federal and private spending. CTOS provides the essential, non-discretionary tools for that work. So the bull argument concludes that this company is a fortress built on a solid foundation of record performance with massive secular tailwinds pushing at its back.
A fortress? Really? From where I'm sitting, it looks a whole lot more like a facade. All right, the bulls have laid their foundation. Now it's my turn to apply the stress test. It's way too easy to get mesmerized by the big, shiny numbers that management polishes up for an earnings call. But you know what? The market isn't paid to be impressed. It's paid to find the cracks. My job is to look past the press release and find what they aren't highlighting. And when you look closely at this report, let me tell you, the cracks are everywhere. Now we're going to look at the numbers management would rather you skim over, the misses, the declines, and the cash burn that tell a very, very different story. Let's start with that so-called record revenue. On the left, you see the number they celebrate in the headline, $528 million. Looks great. But on the right, you see the number that actually matters to Wall Street, a $57 million miss against expectations. The analysts whose entire job it is to model this company's performance were expecting them to bring in over $581 million. They didn't just miss that target, they missed it by nearly 10%. Calling this a record is like bragging about the beautiful view from the Titanic. The market doesn't care about the record. It cares about the massive iceberg of unmet expectations you just slammed into. This isn't a minor shortfall. It is a major, glaring failure to deliver on the top-line promise. And hey, while they technically beat the lowered analyst estimates on profit, let's look at the actual trajectory of their profitability. This is GAAP earnings per share, the pure bottom line. Last year, in Q4 of 2024, they earned 12 cents for every share outstanding. This year, in the supposed record Q4 of 2025, that number dropped to just 9 cents. So let's be perfectly clear. While total revenue and EBITDA went up, the actual profit attributable to each individual share went down. This is the textbook definition of becoming less profitable as you grow. The company is getting bigger, sure, but the slice of the pie for shareholders is actively shrinking. That is a huge red flag for any owner of the business.
This number right here, this is arguably the most damning piece of evidence in the entire bear case. Negative $60.75 million in free cash flow. This is the lifeblood of a company. It's the cold, hard cash that's left over after you run your entire business and reinvest in new equipment. A healthy, growing company generates cash. This company is burning it at an alarming rate. And just look at the trend. It's getting worse, not better. In the same quarter last year, they burned about $38 million. This year, it's over $60 million. All the talk in the world about record-adjusted EBITDA means absolutely nothing if you are hemorrhaging actual cash at an accelerating rate. This calls into question the very sustainability of their operations without relying on more and more debt.
And this shrinking profitability isn't just a one-off. We see it plain as day in the operating margin as well. This metric shows you the core efficiency of the business. For every dollar in sales that comes in the door, how much does CTOS keep as operating profit before interest and taxes? Well, last year, it was a healthy 12.9 cents. This year, that has been squeezed all the way down to just 9.8 cents. That is a massive compression. It tells you that costs are rising faster than sales, that competition is heating up and eating into their pricing power, or maybe that they're having to discount just to move equipment. Whatever the cause, the machine is becoming less efficient at turning revenue into actual profit. And hey, don't just take my word for it. This is how the financial press summed up the situation in real time. This quote from investing.com cuts right to the heart of the matter. The market was not fooled by the positive spin. It looked right past the headline, record results, and zeroed in on the weakness underneath. The market's brutal reaction wasn't some emotional panic. It was a cold, calculated response to a significant top-line miss and clearly deteriorating fundamentals. The bear case is simple. The shiny exterior of record numbers is masking a corroding core of financial weakness. Okay, so we have two completely different diagnoses of the same company. The bull case points to a solid structure with record performance and powerful tailwinds. The bear case points to foundational cracks, a significant revenue miss, and a serious cash burn problem. So where do we go from here? Well, we look to the future. Every company that stumbles has a plan to get back up. Now we're going to examine management's blueprint for 2026 and see if it's a credible plan for recovery. Does their guidance actually address these concerns, or does it just dig a deeper hole?
All right, let's look at the official plan management laid out for investors. This is essentially their don't panic message. For 2026, they're guiding for consolidated revenue to grow somewhere between 3 and 9%, landing just over $2 billion at the midpoint. They also project that adjusted EBITDA will grow even faster, somewhere between 7 and 13%. Now, on the surface, this looks solid. They're projecting continued steady growth in both sales and core earnings. They're telling investors that the Q4 miss was a blip, not a trend, and that the growth engine is still fully intact. This is their promise for the year ahead.
But here's the disconnect, and it is a chasm. While management is promising growth and profitability on their preferred metrics, just look at what the independent analysts on Wall Street are forecasting. The consensus is not for a profit in 2026. It's for a loss of 13 cents per share. Now think about that for a second. The company is guiding for higher revenue and higher core earnings, but the professionals who model this business for a living believe that by the time you count for all the cost, the interest, and the taxes, the company will be deep in the red. This is a massive credibility gap. Wall Street is looking at the exact same plan and concluding it will lead to a net loss for shareholders.
So why the deep pessimism from the street? It's because the road ahead is absolutely littered with the same obstacles that tripped them up in Q4. The company itself acknowledges these risks. They're facing pricing pressure, which explains the margin compression we just saw. The supply chain remains a total wild card. Competition is getting tougher. And then you have the big ones, macroeconomic uncertainty and the risk that their customers simply decide to delay big purchases, which is the exact reason they gave for the big revenue miss in the first place. These aren't new problems. They're chronic issues that could easily derail their entire 2026 blueprint.
All right, it is time to bring it all together and render a verdict. We've examined the bull case, built on a foundation of record operational metrics and strong market positioning. We've put that foundation through a rigorous stress test, revealing significant cracks in the form of a revenue miss, accelerating cash burn, and margin compression. And we've looked at the blueprint for the future and seen a major disconnect between the company's promises and Wall Street's expectations. So we arrive at the final crucial question for any investor staring at that 10% drop. Is CTOS now a bargain opportunity, or is it a classic value trap?
Let's lay it all out, side by side. The bulls have a powerful story to tell. You've got record revenue and adjusted EBITDA, incredible 3-year high fleet utilization, a strong and growing backlog, and confident leadership. Most importantly, they are perfectly positioned in markets with secular tailwinds. The foundation looks solid. But the bearers have an equally compelling and frankly frightening counterargument. A huge miss on the top line, accelerating negative free cash flow, shrinking operating margins, declining per share profitability, and a market that is clearly screaming its disapproval with that double-digit drop. The cracks are undeniable. The entire investment thesis comes down to which of these two columns you believe will define the company's future. Look, there's no denying the operational strengths here. This is a real company doing real work. They are a leader in their field, they are innovating with new products and strategic partnerships. The demand for their equipment is absolutely real and is backed by long-term infrastructure needs. The question isn't whether they are a good company. The question is whether they can be a good stock. Can they translate that clear operational strength into financial results that meet, and more importantly, beat market expectations? Is all this innovation and market leadership enough to overcome the significant financial headwinds of margin pressure, cash burn, and slowing top-line growth? The market has clearly said no, at least for now. And that leaves us with the final question you, the investor, must answer for your own portfolio. Is that massive revenue miss just a cosmetic flaw on an otherwise durable fortress? Was it a one-time issue with customer timing that will be resolved next quarter, making this sell-off a screaming buying opportunity? Or is it the first visible crack from a foundation that is under far more stress than management is letting on? A foundation that is about to crumble under the weight of its own growth and the pressure of a difficult market? The answer will determine whether today's price is a launching pad or a trapdoor. That's the heavy lifting you have to do to forge a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.